whatever it is the BRICS do this time around, whatever they announce, it's probably going to be a step in the direction of a world where gold is at the center of the global monetary system again, at a much higher dollar price than it trades today.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today we have an incredible discussion lined up, and we're fortunate to have with us John Rubino. John is a former Wall Street financial analyst and author or co-author of 5 books, including The Money Bubble, What to Do Before It Pops, and Clean Money, Picking Winners in the Green Tech Boom. He founded the popular financial website dollarcollapse.com in 2004, sold it in 2022. John is the founder of the John Rubino Substack and is a frequent guest speaker. John, thank you so much for joining us today.
Thanks for having me on, Gary. It's good to meet you, and congratulations on your Substack. I hear it's growing like crazy. Nice job.
Well, thank you. I really appreciate it. Well, let's begin with the BRICS. The BRICS countries are meeting in a couple of weeks in Russia with Vladimir Putin hosting. So speculation is rife on whether they'll induct new high-profile members, update their plans for a gold-backed currency, or even spring some other October surprise on the world. How real is de-dollarization coming from the BRICS, and what effects are you expecting to materialize over the next 6 to 12 months? And that could be either economically or even geopolitically.
Well, the BRICS thing is potentially a big deal, as is the whole de-dollarization trend. But last time around, at last year's October meeting for the BRICS countries, they raised expectations that they were going to introduce a gold-backed currency, and then everybody talked about it for about a month, and then they didn't end up doing it. They did induct Saudi Arabia, which was pretty earth-shattering, but they didn't give us that currency that everybody was so excited about. So I'm trying not to have expectations for this meeting, but I got to say though that they have a lot of incentives to ramp up the de-dollarization process. In other words, to start trading with each other using their own currencies, because they perceive that the U.S. has weaponized the dollar and it's using it as a way to prop up its global military empire rather than to facilitate trade around the world and to help other countries get rich. So they want to be out from under what they think of as dollar hegemony. And it's getting more and more urgent as more and more wars ramp up around the world, because the U.S. appears to be, and we've got guys in charge in the U.S. who actually want this. They believe that we need to fight 3 or 4 more wars, win them all, and then rule the world for the next 1,000 years. That is literally the strategy that a lot of these guys are pursuing in the U.S. government. And since we don't have a president anymore, we've got a dementia patient as president, and we've got a vice president who's running for office right now instead of actually governing. So we're very unpredictable. And that gives the BRICS countries, by the way, BRICS stands for Brazil, Russia, India, China, and South Africa. And they have a lot of incentives right now to make something happen. And they've been, for the past few years, ramping up bilateral trade in their own currencies. In other words, Russia and China will exchange yuan and rubles in return for real stuff now. And they bypass the dollar in a lot of transactions. Saudi Arabia will now take currencies other than the dollar. So the petrodollar is kind of dead now. And a currency that is backed by gold and allows these guys to trade with each other without having to hold each other's currencies would be a big improvement over what they're doing now. So, it looks like they're taking steps in that direction. And at some point, they will probably release a gold-backed currency. Because, another aspect of this is that they're buying the hell out of gold in the last couple of years. The central banks, primarily of the BRICS countries, have bought about 1,000 tons of gold in each of the last 2 years. And in a market where the world's mines produce maybe 3,000 tons. So that's a very big number. And that has contributed to gold going up as much as it has gone up in the last few years. So, there's a lot of moving parts here, and most of them are beneficial for gold bugs. If whatever it is the BRICS do this time around, whatever they announce, it's probably going to be a step in the direction of a world where gold is at the center of the global monetary system again, at a much higher dollar price than it trades today. To back, for instance, the US dollar with gold, the way it used to be backed during the classical gold standard of the 2 centuries prior to World War I, you need $10,000 gold. So we're seeing a process with the BRICS that is leading to something like that. So it's fascinating to watch, and it's pretty exciting from the standpoint of, somebody who's probably overinvested in the precious metals sector. And the one scary part of this is that the U.S. might consider de-dollarization to be an act of war and might act accordingly. So, if we think we've got World War III in prospect right now, let the U.S. decide that India and China trading with each other in their own currencies is something that needs to be stopped. And then we'll see a whole new level of craziness out there.
So, John, even in an emerging multipolar world, there's no obvious replacement for the deep liquid U.S. capital markets. So the dollar won't disappear from global trade. However, if the BRICS have the commodities and the U.S. and its allies are left with the finance side of things, what happens to the pricing power for crucial things like oil and gold?
Yeah, well, the point you made about the dollar not going away is very important because, the U.S. capital markets are irreplaceable right now. You just can't do a lot of things in yuan or rubles that you can do in dollars, and that's not going to change for a long time. So the dollar will exist as an important trade currency in the U.S. financial markets. Will be a place where lots of things get done. But also, like you said, if we've got the commodities producers on one side and the finance guys on another side, then the physical is going to set prices. And since it's in the interest of OPEC and China with its rare earth elements and Russia with all its vast natural resources, it's in their interest to get as high a price as possible. That's inflationary for us on the consuming side. But now, one other aspect of this is that the U.S., well, let's say North America, because Canada and Mexico are part of the story, we're pretty much self-sufficient in almost everything if you look at North America as a single financial and economic entity. So we aren't as at risk as a lot of people seem to think we are, just because if we wanted to ramp up the whole drill, baby, drill thing, we could be net energy exporters and completely energy self-sufficient in a heartbeat, relatively speaking. So that's a thing that's out there too. So there's no real guaranteed scenario and guaranteed path for this to progress. It's just a lot of moving parts, most of which are unfavorable for the dollar's exchange rates, but not all of which. A lot could happen going forward. But I think the BRICS thing is a legit threat to U.S. global financial dominance in the intermediate term and definitely in the long term. In the next few years, maybe not so much, but it could be kind of a self-fulfilling prophecy where the story gets around, people start to expect it, they start to act accordingly, and then the dollar's exchange rate falls because of that, which is inflationary. So, I think the excessive debt that we've taken on in the U.S. and in the rest of the world kind of guarantees inflation going forward. You can't have this kind of debt without creating a lot of new currency in order to service that debt. So we see inflation regardless. And then all these other moving parts like the BRICS get to determine how fast the dollar and the euro and the yen lose value. And that's what remains to be seen. And there's an outside chance that it becomes disorderly, that decline, in the not too distant future. And then we get financial chaos. But it's also possible that it goes on much longer than seems reasonable. That's kind of the way markets usually work.
Right. So if the BRICS trade bloc leads to their fully investing their reserves in gold rather than U.S. treasuries, then the U.S. wouldn't be able to weaponize their reserve currency either to the degree that they have or even anymore. Does that lessen their ability to impose their will on the rest of the world? And if that's the case, what are the ramifications of that?
Oh, it absolutely does. That's why I mentioned that the U.S. might see it as an act of war, because and Trump has talked like that actually during the campaign, where he says, well, if they don't use dollars, then we'll just put 50% tariffs on their imports, or, whatever. He sees that as a threat. And, it's completely possible that we'll see it that way and react to it that way. But yeah, as other countries need the dollar less and less for trade, they need it less and less for reserves. And there's, what is it now, $10 trillion sloshing around outside the borders of the US and the world. And if those dollars come back here, in other words, if people sell their treasury bonds and somebody else owns those bonds and they want to cash those bonds in for real estate here or for factories or housing or whatever, that definitely is inflationary from our point of view, because that would be extra currency chasing a relatively fixed number of potential acquisitions. And so that would make prices go up, which is the same thing as saying the dollar goes down. And yeah, that's part of the process. It's an inflationary process, and one that is kind of baked into the cake, but the magnitude is the thing we have to, and magnitude and timing is what we have to find out.
As the U.S. debt burden grows bigger and bigger, do you expect it to manifest in rising yields for U.S. debt? In other words, won't those willing to be long-term debt holders demand more yield for the loss of purchasing power that they're guaranteed to get? And what is the outcome of a world with higher long-term debt yields?
Yeah, because the more money we owe, speaking from a governmental level at the U.S., the more currency we have to create to service that debt. And a bigger supply of currency leads to a fall in currency value, just basic supply and demand. In other words, prices rise, the currency falls. And that's a big issue, because at some point people just give up on a currency. When it's explicit government policy to inflate your currency away, people tend to stop trusting it, and they start dumping it. They start converting it into real stuff. That's the process is called the crack-up boom in the Austrian School of Economics. And it leads to a currency crisis in which the currency doesn't react anymore to supply and demand, or it doesn't react to the supply as the central bank increases it. It reacts to the demand from people who lose faith in it and just don't want it at all. So you see a kind of falling off the table move in that currency. It just collapses. And that's the big risk when you start borrowing the way we're borrowing. So the global ramifications are that all the big currencies move into this stage of the process of devaluation, kind of sort of at the same time, and it becomes disorderly, where they can't control it anymore. That's inevitable if we keep borrowing money like that. And again, it's just, when's that going to happen? Is that a next year thing or a 10-year from now thing? And I don't think that's really predictable, except to say that we have entered a new stage where we took on massive amounts of debt. Then we had to raise interest rates to lean against the inflation that inevitably was going to happen. And in 2022 in the US, we had almost double-digit official inflation. And that spooked a lot of people, caused the government to raise interest rates. And then we hit this next stage where higher interest rates lead to higher interest costs that become debilitating if you're over indebted. And in the case of the US, our interest costs on the national debt went from $300 or $400 billion a year to over $1 trillion a year. And it's not done yet. It's still going up. So we could see $1.5 trillion just of interest expense on our debt. And that's potentially devastating for a government. Japan is potentially in an even worse place because it has more debt relative to GDP than the US does. So let its interest rates even go up to US interest rate levels, and the government is bankrupt. So these are things that are out there. They're going to happen. Unless some really, really extreme thing happens to change our course. And there's nothing on the horizon other than World War III, which is maybe a 20 or 30% probability right now based on how idiotically everybody is behaving in the world. But barring that, this the financial stuff kind of has a life of its own, and it's kind of predictable, although not in timing. But we'll see these currencies evaporate.
So regarding this debt issue, that's not just United States, it's global. It's something like 315 trillion in global debt. Are you anticipating the governments to do whatever they can to reduce the impact of the enormous debt and unfunded liabilities in real terms? How do you see this playing out?
Well, to do that, they have to lower interest rates dramatically, because that lowers their interest cost and makes debt manageable. And that's how the last 18 or so years went, where governments were gradually pushing down interest rates, which offset their increasing debt and kept their interest costs more or less stable. And that's basically their one tool right now. But we found out in 2022 that there's a limit to that. You can't create unlimited amounts of new currency without it becoming inflationary and just totally freaking everybody out. So we're at a point now where they have to lower interest rates in order to keep debt costs from blowing up the budgets of all the major governments. But they know if they lower interest rates back to where they were, that's potentially inflationary, and that people, now that we know that inflation is possible in the US, will front run it next time. As soon as, and instead of waiting for interest rates to go up, or inflation to go up to 8 or 9%, as soon as it gets to 3 or 4% on a rising trajectory, we'll be back out there at Costco buying all the toilet paper we can get a hold of, and we'll be selling everything that even resembles a government bond. So that will push up long-term interest rates. And then the government might find that it can't control interest rates after all, and then it's game over. So that's another thing that's probably baked into the cake, because we have so much debt and we're continuing to take on more debt, that the whole financing of that debt with lower interest rates has to happen to avoid a catastrophic deflationary crash. So
because of what you just described, do you think that the Fed interest rate cuts and raise cycles are going to get shorter and shorter and shorter so that they could front run some of these issues?
Well, they'll get more chaotic because, now that we know what game they're playing, they can't stretch it out for a very long time, or they can't force interest rates down as dramatically as maybe they would like to. So then what do they do? It could be that if inflation picks back up again, they have to raise interest rates again, but then their interest costs will spike. We might have a couple truncated cycles like that. So, okay, to answer your question, the time frame might compress before the thing falls apart. But again, you can't know any of the details of this stuff. There's lots of scenarios by which this can play out. But the fact that most of the major fiat currencies now are in their death cycles, it kind of tells you that it's coming, and it's coming in it's not a 50-year thing. It might be a 10-year thing, but it also might be a 3-year thing. So that stuff is headed our way. We just have to see. And from an investor standpoint, it's not really that big of a deal whether it's 3 years or 5 years, because you want to do the same things regardless. You want to be stacking, among other things. You want to be buying those real assets that panicked people will be piling into later on when things get disorderly. So our investment thesis is kind of fixed here. We want to load up on real things that governments can't create in unlimited quantities. And gold and silver would be right there at the top of that list. So we should just become gold bugs. And that's at least a third to a half of what you really need to do to prepare for this.
So it's highly likely, just as in troubled times past, that the Fed would turn back to QE, in a New York minute on signs of market distress, right? What exactly does the alternative to QE look like if they didn't go back to that, allowed things to play out in the next moment of market distress? What does that look like?
It looks like chaos. One scenario is, okay, inflation starts to pick back up. interest rates at the long end of the yield curve start to rise because nobody wants to lend money for 10 or 20 or 30 years in an inflationary currency because you get paid back in currency that's not worth what you lent out. So the markets demand higher interest rates, but of course that spikes interest costs for governments. They can't handle that, so they try to push interest rates back down, but they find out that the markets aren't letting them do it. And so if interest rates are going to rise and the Fed can't stop it, that means all the leverage speculating community, everybody that's got variable rate debt or debt that has to be rolled over, is in extreme danger. And that's deflationary. For instance, if the commercial real estate market, all these office buildings out there that were bought or built with cheap money during the 2010s, those things have to be refinanced now that that debt is coming due, but at a much higher interest rate. Those buildings are no longer generating enough cash flow to cover their financing costs, so they go bankrupt. So you basically eviscerate a whole sector of commercial finance, and you get all these things going bust, and then the banks have to eat the related losses, and then the banks go bust, and so you start a banking crisis that way. But it begins with the markets not wanting to hold government debt anymore. And once one over-leveraged sector of the economy starts to crash, it threatens a lot of other sectors of the economy that are also kind of bubbly. The stock market's not going to stay at record high levels if you get a big sector of commercial real estate going bust and the banks following suit. So if stocks tank, then what does that do to derivatives, and so on. You get kind of a cascade failure of all these over-leveraged sectors. And that is what would happen if the Fed loses control of long-term interest rates and they start going up. So that's one of the scenarios that it makes a lot of intuitive sense. The Fed is going to try QE in the not too distant future, which is to say they're going to try to push down long-term interest rates with newly created money by buying long-term bonds. But if that doesn't work, then they're out of tools. And then you hit that point where everybody realizes, there's no adult supervision in these crazy markets anymore. And so people's response to that will be to get out of those markets. So then you get multiple crashes across multiple bubbles and with no real fix in sight, because if central banks can't save us, who's left?
That's a pretty bleak picture, to be honest with you.
It is, yeah.
Yeah, and it seems like it's bleak whether they choose QE, when you factor in the law of diminishing returns, or they don't choose QE and they allow natural cycle forces to play out.
Well, you reach a point when you've borrowed more money than you can ever hope to pay back, that your life becomes chaotic, right? That works for individuals. That's really easy to envision.
Right.
Max out 3 or 4 credit cards, and then carry the balances at 25% interest, and you soon go bankrupt. You lose all the stuff you bought with that credit card debt. It's works the same way for governments. So governments use different terminology, and they pretend that they're above all this, but they're not. So envision what your life would be like if you maxed out a bunch of credit cards and they blew up on you, and then just extend it to the whole world. That's kind of where we're headed. All the big governments are basically in the same place. They're in effect credit card debtors, and the interest that they pay can spike just as easily for them as it would for us if we just carried a balance and paid the 25% interest. So that's the kind of thing that's inevitable now. And that's, that is bleak. You're right. But it's the kind of thing that happens when you make the mistakes that we've made. But it's not that bleak from an investor's standpoint, because in every crisis, there are opportunities that are created. So in the Great Depression, most people lost their shirts. A handful of people made generational wealth. In the housing crash of 2007, 2008, 2009, most people lost a lot of money. But if you saw the movie The Big Short or read the book, you know that a lot of people, or a relative handful of people, but a few, who saw the crash coming bet against that market. They were wrong for a while, but then they were right, and they made life-changing money there too. So that's the opportunity that's out there for us.
Yeah,
Just
and
right.
sadly, too many are not paying attention, and they're going to get run over, by a steamroller here. But that's our job to keep, educating and sounding the alarm.
Mm-hmm.
But John, homes are completely unaffordable. You've kind of touched on this for so many. Despite mortgage rates having come down off their highs, buyers, they're not coming back to the table. In fact, inventory is spiking all over the country as the number of sales plummets. And I just read recently that a good percentage of realtors are walking away from the position. In your analysis, how bad will circumstances in residential real estate have to become before the out of balance market comes back into some kind of equilibrium?
Well, if you mean by bad, you mean lower prices? A ways from here, because basically the way housing cycles go is they go up in price and they go up in price, and people keep buying them because houses never go down. It's the best investment in the world. And then they reach a point where the average person can't afford anything close to the average house. And sales kind of dry up because literally people cannot buy a house anymore. They can't buy anything that they think is worth living in. So sales just compress. And that's where we are now. So what happens next is that the people who, kind of have to sell for whatever reason, or have been thinking they should sell, but the house has been going up, so why not wait a while? They start to feel like they've got to get out. And so they put their houses on the market. And those houses don't sell because they're pricing them. The sellers are pricing them at today's prices, which are unaffordable for the vast majority of people. So then the sellers start cutting. They either pull their houses off or they start cutting prices. And you can go to Zillow now and you can see how many reductions have happened out there. And it's something like 35% of houses on the market now have had their prices cut, their asking prices. And that starts to snowball when you really find out you do need to sell, and you got your house on the market, you've already cut it by 20 grand, and you're looking around and similar houses are being cut by 30 or 40 grand. You say, all right, I'm just going to sell this at whatever I can get for it. And then the floodgates open and house prices just plunge. And we're not far from that because of the number of reductions that you can see on Zillow right now. So, and the supply of houses for sale is finally starting to go up. There was a house shortage, an outrageous one for a long time, because nobody wanted to sell their house when it was going up, and they had a 3% mortgage. And now that's changing. People are starting to put their houses on the market. The supply is increasing. So you've got stagnant sales at the moment, and then you've got rising inventories that are being cut in price. And that sets the stage for a panic. And then in every housing market, prices start to fall. And sometimes they fall in a really disorderly way. Like 2008, 2009, you saw houses drop by 40 or 50 or 60% in a lot of markets. And that's historically unusual, but 10%, 20%, 30% in some markets is completely doable going forward. And so that's something that we ought to see, everything else being equal. Even if there's not a financial crisis coming, housing is ready for a couple of years of declines in price. And we're right at the beginning of that.
So global chaos is clearly intensifying as things are exploding everywhere. Cargo ships, oil depots, cell phones, among other things, they're all exploding everywhere. Things are beginning to look a lot less manageable than before, as there is this spinning out of control feeling happening. What do you anticipate happening next here globally with this? Should we be prepping for what might follow, or should we be expecting everything to simmer down and return to a more normalized state? How do you see this unfolding?
Well, it's possible that the guys that are causing the chaos now find out they don't like it and then take some steps back, and we settle all these forever wars out there and go back to status quo ante of maybe 2019 or something like that. And that would be so great if we do it. But the people in charge right now don't seem like that's their main priority. They want to win, basically. So we've got a world where Boeing can't make jets anymore. Their jets are falling from the sky, and a lot of other manufacturing related things just don't seem to work in the U.S. Like our bridges are collapsing, and we're having all these natural disasters that are costing vastly more than they ever cost before. And you've got countries in the Middle East bombing hospitals and oil refineries and threatening to bomb nuclear reactors. And you've got the U.S. sending high-tech weapons to Ukraine that are capable of reaching deep into Russia, even though Russia has said that's a nuclear red line. All of that stuff is happening in the world. And it's terrifying. So that's one of the environmental things that send capital looking for safe havens. So yeah, if the world's if the world stays this chaotic, or God forbid gets more chaotic from here, then you see financial flows, capital flows, into stuff like farmland and energy assets and things like that. And of course, gold and silver, because people are more and more concerned about protecting wealth than they are about building it. So all of a sudden, safety becomes the main priority in a chaotic world. And if we can't fix this, if it gets more chaotic from here, then the capital flows will just intensify. And ironically, the kind of chaos that we're seeing in the world, it helps the dollar, even though the U.S. is the cause of a lot of the chaos. And that's because as bad as it gets here, it always seems safer than it does in China or Brazil or Russia or someplace like that. If you've got a lot of money in China, you want to move it to a place where you at least get to keep half of it when everything hits the fan. And so that might be a Miami condo or something like that, or a piece of Vancouver area farmland or something. And so that actually props the dollar up temporarily. So you might see the dollar be quote unquote strong versus the euro and the yen and the yuan and pound sterling in the next couple of years. But in the context of all of those currencies falling in value just irregularly, maybe the US looks pretty good compared to the euro because the US dollar only lost 9% of its value and the euro lost 14%. So when people talk about the dollar being strong in the next few years, you need to understand what metric those people are using. If they're comparing it to other fiat currencies, that's faint praise. But if they're comparing it to purchasing power, that's a legit measurement. And that means the dollar actually is strong. That means prices are going down, okay? Which is highly unlikely in the near term.
I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with John as much as I have. Please let him know by hitting the like and subscribe button and leave a comment below the video.